Hi, Lenore here. I'm back. Like a bad dream, right? No, let's talk about financial statements now. The first financial statement that we prepare as accountants, I don't know why there we go, is the income statement. And the income statement is created by adding up all the revenues a company has for a particular period, example a month, and subtracting all the costs, or what we call expenses. So once we do that, let me write that here, revenues less expenses. Once we do that, we end up with something called net income. Now, you may have heard this called the profit, and that's correct, but net income is the word that we use for revenues less expenses, and the statement is the income statement. Now, we have to do it in this order, so the income statement comes first. And once we've finished our income statement, then we're going to work on something called the statement of retained earnings. This is going to be our second statement. The statement of retained earnings is the situation where a company has multiple months that they've recorded their income for, and they keep track of the net income for different months think of it as a big bucket. And that bucket's name is retained earnings. So one month they have $10,000 net income. The next month they have $3,000 in net income. So in essence, their retained earnings would be $1,000 plus $3,000, or a total of $4,000. That's retained earnings. So income statement comes first. Statement of retained earnings comes second. And the last financial statement, and this is the big one, this is where you find out, have I done something wrong? And it's called the balance sheet. The balance sheet is where a company shows their assets or lists them all out. Remember, these are things the company owns. And that list must equal the liabilities, everything the company owes, plus the equity. And included in this equity, stockholders' equity, remember, is retained earnings. So let me go over it again. First, the company keeps track of its profit, also known as net income, revenues less expenses. Once the company has determined what their net income is, they're going to use it in order to determine how much net income they've had for the larger period of time, generally year to date. So this could be 1 month. Generally think of it as 1 year. After the company has determined what their retained earnings is, they can then create their balance sheet. And their balance sheet is a snapshot. At that period of time, their assets are X, and those assets equal the liabilities plus the stockholders' equity. Those are the three financial statements that we're going to use, and we're going to be able to prepare. So, with that said, Lenore out.